weekly market commentary for the second week of November 2025. Markets ended up flat after being on the back foot at the end of last week, as markets seemed to be worrying about the extent of the capex rollout in the US, but also probably more so about valuations and how those two things combine, maybe looking out a year or so, and basically whether there's going to be a return on investment on this huge amount of money that's being invested in AI infrastructure. But that was soon resolved, as over the weekend there was rumours of a deal that would end the government shutdown. So far that's been passed by the Senate and should be approved by Congress, and that means that markets have basically made back that 3% in the US that they were down, especially for the Nasdaq. And also, as we've sort of come to expect recently, emerging markets, global small caps outside the US, even the local market, much less volatile and pretty much flat for the week. Gold made a little bit of a comeback after being on the back foot for a few weeks and up 4% for the week. And Europe actually up overnight and up a couple of percent over the past week. Japan, again, volatile, but up a couple of percent. So, reasonably solid week. And when you zoom out, really, even though markets have had a sort of pretty soft couple of weeks, they're really back where they were only 4 to 6 weeks ago. Again, if you zoom out interest rates over the past week, so not much movement, but there has been a lot of talk from central banks about increasing capacity constraints, and it not necessarily being a given that we're in the middle of a downward rate cycle. And in fact, the next move, some people are saying in some markets, even in Australia, could even be up as we start to see capacity constraints, as we mentioned in the US. Very polarized. On the one hand, tech infrastructure really causing some problems there, and in terms of energy prices filtering into some parts of the economy, and you're seeing that sort of broaden. So maybe some worries about inflation and capacity constraints, but very polarized. Labour data suggesting that lots of the other the rest of the economy not doing so well, and that old K-shaped thing may be coming to the fore, which is politically difficult to navigate. And even in Australia, the RBA governor also suggesting that we do have some capacity constraints here and a little bit worried about inflation because of that. So when you look at yields, this is showing up the top of the graph, long-term yields, 10 years, and down the bottom, the shorter-term ones, and in white, just a year out. You can see there's been a downwards trajectory, which has really helped markets over the past year, and it's just started to edge up a little bit, but not too dramatic. In Australia, it's been even more range-bound at the long end. That's up the top of the graph. But you can see there's been a little bit of volatility recently in past few months and been edging up quite consistently over the past 4 to 6 weeks. And what that really means for homeowners is the hope of more rate cuts seems to be slipping away. And we've seen pretty strong housing markets. Maybe that's going to cause pause for thought. As we said last week, Andrew Hunt has just done an Australia review, and he reckoned the outlook could go either way. So hopefully next week we're going to get him along to talk about that in a little bit of detail, as we know it's an interesting talking point. This is a short one, as this part of InvestSense is interstate the next couple of days, so know what we're working on. But one thing that we have been working on, and that we'll be talking with Andrew again, is this graph here, which is kind of interesting. It's showing the amount of cash in terms of flows that's built up in the US economy over the past 5 years, and that's about 5 trillion. But there's also been strong flows into equities, as we know, even into bonds, and an interesting one down the bottom, even though flows into gold have ramped up massively in absolute terms compared to those other asset classes, really not very much at all. But the takeaway from that is there's about 10 trillion of new money flowing into the US. And as far as we can see, when you sort of pull this all apart, that really amounts to about 5 trillion, which has actually been monetized, which has been printed. If you remember quantitative easing before COVID, that had a sort of nuanced effect as it held yields down, as the government, the US government, essentially bought bonds off banks, but they were deleveraging, so they weren't lending that money out. So it wasn't a monetization process, and it didn't really feel like, and really wasn't in substance, money printing. But what we've seen since then in various guises is actual outright money printing, which amounts to about 5 trillion going into the US economy and then flowing out around the rest of the world. But also the net flows into the US in terms of capital flows have been the other 5 trillion. That's as far as we can see. We're going to talk to Andrew Hunt because he's really the expert on that. And that really explains a lot, apart from obviously the corporate prowess that we've seen in the US earnings season. But there is something else going on. Liquidity seems to be very important. We see more and more evidence of that. So that's something that we're going to dive into in a little bit more depth over the next few weeks with Andrew. And we think it's going to be an interesting talking point. Look forward to talking about that more in the near future. Thank you.